This might be the year for these top utilities sector picks to shine. Utility stocks were the worst performing sector in 2023, but these top utilities sector picks are ready to bounce back. Brookfield Infrastructure Partners. The diversified utility and infrastructure operator uses a wash, rinse, repeat growth strategy. Consolidated Edison. The New York-based electric utility is investing tens of millions of dollars in new growth projects. York Water. This seemingly sleepy Pennsylvania water utility is handily beating the long-term returns of the S&P 500. Let's dive in. Is 2024 the year for utility stocks? Here are the 3 top sector picks. Welcome to Timely Investment Research. It was an ugly year for utility stocks. The rapid rise in interest rates by the Federal Reserve caused a drag on utility earnings. Utility borrowing costs rise because they are capital-intensive and rely heavily upon debt financing. Utilities end up taking a hit on earnings. Also, income investors sour on utilities as bond rates look more attractive. That doesn't mean there aren't top utilities sector picks to consider. While last year was a bust, can 2024 be better? There are reasons to think so. The Fed will likely cut rates this year, possibly 3 times or as many as 6. That might be aggressive, but a falling rate environment suggests utility stocks might be a good investment now. Here are 3 top utilities sector picks you will want to add to your portfolio today. Number 1. Brookfield Infrastructure Partners. Brookfield Infrastructure Partners is not your typical utility stock. It is one of the largest owners and operators of critical global infrastructure networks. Yes, that includes traditional utility operations, but it extends to railroads, toll roads, ports, data centers, data transmission assets, and 2 semiconductor manufacturing foundries. Its diversified portfolio of critical assets explains why it held up better than most other utility stocks. Brookfield Infrastructure Partners stock managed to eke out a 1.6% gain last year. It's not world-shattering but better than the losses other utilities offered. Brookfield engages in a cycle of selling mature assets and reinvesting in better, higher return opportunities. It calls the strategy buy, enhance, sell, repeat. Yet regardless of whether they are new or old assets, all the businesses tend to have the common denominator of producing stable, reliable cash flows. No matter the market, long-term contracts and regulated frameworks underpin 90% or more of their funds from operations. The diversified infrastructure play pays a dividend that yields 5% annually. It targets annual dividend growth of 5% to 9% and reinvests leftover retained cash flows into new expansion projects. With a safe, well-covered payout, Brookfield Infrastructure Partners is poised to capture greater growth as interest rates fall. Number 2. Consolidated Edison. Consolidated Edison is a more traditional electric utility, one of the largest publicly traded energy delivery companies. It provides electricity, natural gas, and steam to 10 million customers in New York State. COND, as it's known, has been in business for 200 years, paid a dividend for 100 years, and has increased the payout every year for 50 years. That makes it a dividend king. The dividend yields 3.7%. Although COND got into the renewable energy business, it sold those operations to RWE Renewables Americas for $6.8 billion. The deal freed the utility from issuing equity to finance its expansion plans. The proceeds also allowed it to pay down debt, invest further in its core utility operations, and add to clean energy transmission projects, battery storage, electric vehicle infrastructure, and other renewable power generation projects. The utility stock envisions investing $72 billion over the next decade in its core operations, as well as in clean energy and so-called climate resilience to insulate its business from the purported effects of climate change. Investing in Consolidated Edison means investing in a growing income stream from a solid company expanding its energy generation opportunities. Number 3. York Water. Even older than COND, Pennsylvania water utility York Water has been in business for 207 years. It's also paid a dividend every step of the way. No stock on the market in any industry has paid a dividend longer than this water stock. It's a sleepy, under-the-radar utility serving almost 50 municipalities in south-central Pennsylvania. While you shouldn't expect utilities to turn on their afterburners and rocket higher, don't count out York Water. Over the past 23 years, the water company's total return has exceeded that of the S&P 500 by 3 to 1. York Water generated over 1,200% returns for investors since the turn of the century compared to 400% returns by the index. What do you get from York is a patient, steady grower. It increases sales by adding more customers to its portfolio, but more commonly grows through rate increases approved by regulators. An investment is almost guaranteed because clean water and wastewater treatment are necessary. Regulators may delay rate hikes, but ultimately must approve them to allow the utility to invest in maintenance, upgrades, and expansion. York Water's dividend yields 2.3% annually, and this top utility sector stock pick has increased the payout for 26 consecutive years. If it were a component of the S&P 500, that would qualify it as a dividend aristocrat, but it's an income-producing champion nonetheless. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.